Welcome back. We're well off the highs of the morning. The Dow, S&P and Nasdaq now all in the red as the new Chinese tariffs are set to go into effect on Sunday. Joining us here on set, Bob Pisani and Mike Santoli. Bob, let's start with just this little last 40 minutes of selling. Running out a bit of steam after a strong bounce back the last couple of days?
The problem is all of these rallies, even in August, feel very tentative because no one knows what side of the economic divide you're supposed to be on. Are we supposed to be on the side that there's going to be a slowdown that's coming? That seems to be the prevailing paradigm. But how far is the slowdown? Is it a modest little slowdown globally, or do we go into a more serious recession and earnings drop 10 to 20%? Or do we get a resolution to the trade disputes and things kind of calm down and earnings are up 5 to 10% in 2020? This is, Mike and I were talking about this earlier, you could drive a truck through the bid-ask on the earnings estimates for 2020. They're much wider than normal, and that's making everybody a little crazy trying to figure out where we should be right now.
And Mike, we've seen that play out over the course of this month. Very big moves, often always in the same direction.
Yes, absolutely. On a daily basis, it really has been a market trading almost as one many days. What we did do is yesterday close exactly where we were a week earlier. The market's been trading a little bit mechanically and technically. We got very oversold. And I do still think that the direction of kind of rotation and mean reversion is probably in favor of stocks right here, just in the very short term. The B of A Merrill Lynch kind of bull bear indicator that we talk about, which is a composite of just positioning and sentiment and just how far we've overshot. So that's just the real tactical back. That doesn't get to what Bob's talking about, which is really the big fundamental story that's going to drive the next phase here. So I think we're kind of figuring out if on a pre-holiday week, 3 days of no trading. We have tweets and headlines that we might expect over 3 days, and we've already kind of gone back to the upper end of this month-long range. Maybe that's why we're just backing away a little bit here.
Do things change in September at all? August is kind of known characteristically for having lower liquidity, a lot of people out on vacation and enjoying their time away from the screens a bit. So we have tended to see a little bit more reaction to every nuance of this trade debacle. Does that change in September where more people are kind of paying attention, more people are trading, more people are back to work?
I would think it would change in the sense that there are people trying to position for the fourth quarter. That is something that happens, putting more real money in place. But September hasn't been a great month. It's not as if it directionally helps you out because historically, if that matters, it's been weak. I still think we're kind of dealing, though, with the same issues. We're kind of leading up to the last month of earnings season and all the rest.
Don't think more liquidity necessarily is going to save you in a down market. It won't. Yes, it can exacerbate moves a little bit, thin trading, but on either side, the rallies can get a little more extreme. But if people feel that it's very uncertain and the outlook is very uncertain, you're going to move very quickly now, whether there's liquidity or not.
I mean,
it's not a down market, no. We are 5%. At the worst, we had a 5% move. Right. Now we're 3% off of the historic highs. So, yes, we're not even in a garden variety correction because the volatility has been very high.
Right. It's an interesting dynamic here, actually. Your whole, how wide your aperture is tells you what the picture looks like right now, because literally 2,900, I think, is where we ended August of 2018, and that's basically where we are right now.
But we've been in turmoil several times over the past few weeks, despite the fact
you had a
that
20% decline in the fourth quarter. May, you actually had about a 6 or 7% little pullback, basically the same magnitude in August. So you're right. We're just kind of wobbling not too far below the
And this
highs.
is one of the reasons the risk is to the downside, because with only 3% off of the highs, even if you've gone nowhere for a year, you're still close to the old historic highs. So the earnings are basically flat for the year. You're still dealing with close to 17 times forward earnings, still a little bit on the high side. So anything could if we were down 10, 15% below here, it'd be a lot easier to see rallies on the upside because people would be wanting to buy lower. You notice the rallies this month, they have been rather poor on the volume. The downside moves, though, last Friday, we had a huge volume. All the big ETFs had twice normal volume. People were out selling for sure on those down days. On the up days, the buying enthusiasm is not as strong because people are looking at this saying, should we really be buying a lot right here in the market?
Come at the same thing from a different angle, though, which is, so we're at the same level the S&P as we were a year ago. 10-year Treasury yield a year ago, pushing 3%. You're half that right now. You obviously have this flattening out of earnings growth. Last year, the Fed still had another 2 hikes in it. and this year, obviously, you're cutting. So if you want to create a bullish story around that, that's what you do. It's just relative valuation as opposed to things look great and earnings are going to grow a lot.
Yeah, you very rarely get Treasury. Long-term Treasuries are up 10% this month. You're going to go a long way before you ever see a month with long-term Treasuries up 10% and S&P down, 3% right now. It's a very unusual mix.
Bob and Mike, thanks very much. See you both later.